Hi, I'm Sameer Jain, founder of ActiveAllocator. If you invest in real estate, you'll find ActiveAllocator to be a great resource because we allocate to core, value add, opportunistic private real estate. We help you blend that with public REITs. So, over the past few years, long-term real estate investors have done pretty well. Low interest rates, along with a wave of capital, has created what appears in hindsight to have had been an insatiable demand for that asset class. And that was all across the risk spectrum, from development to environmentally contaminated properties, from value add to core, from international to domestic. Yields compressed significantly due to the weight of this capital. Fortunately, this capital overhang is now dissipating. And it was easy, even for the least skilled of investors, to profitably buy and trade real estate, which has had the effect of driving prices to levels which I think will generate returns that are going to be below historic norms. Rising land, commodity, labor costs have limited construction across most of the US, which has created a sense of comfort, allowing investors to discount the risks of new supply. So to me, it appears that this is really not the time to reach for yield, but rather to carefully select managers with true value-added capabilities, and to identify managers that are willing to assume some disruption in the capital and real estate market cycle in the near to medium term. And the less prudence with which others appear to be investing and allocating their capital, the greater the prudence required by us in investing and allocating capital. So let's look at some very crude classifications. Core real estate, something that everyone does. Fully leased properties seem to be priced ahead of their underlying operating fundamentals. And I think they are unlikely to produce acceptable returns at this point in the investment cycle. My take is large open-end funds will suffer through recalibrating investors' return expectations. There are many medium to small open-end funds with appraised values that are lagging transaction prices. So the conclusion, I guess, is there is too much money chasing too few deals, and it is not a good idea to do this at this point in the economic cycle. My own view, and this is just a personal view, is investors should sell into this market cycle rather than participate passively through core fund vehicles. Value-added real estate, something that we allocate to at ActiveAllocator, seem to be with reasonable valuations. Currently, they are an attractive sub-asset class to deploy capital, but accessing the best opportunities has always been and will continue to be a challenge. So one should deploy capital when high-quality funds and really good opportunities are available. Otherwise, one should just proactively position oneself with fund managers that open up in the next 1 or 2 years. Opportunistic real estate? Well, fund managers are increasingly going outside the US to generate higher returns, and we see intense competition by investors to gain access to the best historical performing managers. And within mega funds, the alignment of interest is being diluted by fee arrangements. We've seen some attractive opportunistic themes in Germany and in Europe, largely driven by privatizations and corporate dispositions. Japan too seems to be okay with a positive yield spread with value-added exit to J-REITs. In India, it's still development and residential, and the economy is growing at 7, 8, 9%. Huge opportunity to deploy capital there. China, I'm not too sure. So the overall conclusion is, currently it is an attractive segment within real estate to deploy capital, but accessing the best funds, the best opportunities is a huge challenge. And one should only deploy capital only when very high quality funds open up and they accord access. So at ActiveAllocator, you can build portfolios that allow you to blend the right amounts of core, value-added, opportunistic private real estate along with public REITs in the right amounts. I encourage you to take a test drive, check out our website, and if you like what you see, get in touch with me. Thanks so much for listening in.